Well, hello, everyone. Thank you for joining us today for another episode of Two Economists and a Lender, where we take a deep dive into the most important economic issues facing agriculture. I'm your host, Carly Jacobson. And this month, we again have David Widmar and Brent Gloy back with us from Agricultural Economic Insights, along with our own Tara Reppert, one of our own credit analysts here at Farm Credit. So today we're talking about how the different parts of our individual or operations credit profile work together to help a lender understand what we're capable of earning, aka paying back. So we'll talk through the 5 C's of credit and also discuss how your credit profile can have offsetting factors. Nothing is black and white in farming or finance. So Brent, let me get this kicked over to you to get us started.
Thanks, Carly. Great to be here with everyone today. Here to talk to you today a little bit about the 5 C's of credit, or more generally, the underwriting process that lenders use to evaluate credit. And I think we all know that credit is one of the most useful tools that we have in our business toolbox. It's can help you invest in things that make your business more efficient or grow it over time. And so it's something that a lot of us desire. But one of the things that I think causes some frustration sometimes is people, well, I didn't get that loan, and why didn't I get it? And what is the lender really looking for? What do they, how do they evaluate when they decide whether they want to extend you credit or not? And I think that's where understanding the process is really important, because it's certainly in the lender's best interest to extend credit when it's a good credit, and it's in the business's best interest to use it when it makes sense. So what we wanted to do today is talk a little bit about what makes a business creditworthy and what lenders are looking for. And so I think part of this whole process is telling that story of your business as to what makes your operation unique, what makes it creditworthy. And by creditworthy, we mean the ability to take credit, invest it, and earn a rate of return that will repay the lender both in their principal, but also the fees that they're going to charge you to obtain that credit. And then, more broadly thinking about just what goes into that process, what's necessary, and what are the most critical pieces of information that we use in the underwriting process. So today we're going to flip it around a little bit. We usually bring our lender expert in at the end, but today we're going to bring them in a little earlier, and I'm going to let David go ahead and introduce our lender expert for the day.
Yeah, Brent, thanks for that introduction. We're going to work through each of those 5 C's. We're going to explain what each one is, and we're going to set it up a little bit. And then we're going to ask Tara, our lender expert this month, to share her perspectives. First off, Tara, tell us a little about yourself.
I have been with Farm Credit Service of America for a little over 19 years. I started as a financial officer in our Northeast Nebraska region out of Norfolk, was able to work with customers there to put on loans, work with them with crop insurance and deciding what best to take there. From there, I moved into an underwriting role with our organization. So I've been able to be on the backside of that loan gathering process and looking at all these credits. I've also gotten to do some fun things with our technology within our organization, where I've actually helped build some tools that look at these different capital and credit and capacity measures. So know the nuts and bolts that go into it. In addition to that, I'm lucky enough to live on a farm here in Northeast Nebraska now, out of West Point. My husband farms with his family, and so we are hoping to be raising up the 5th generation of farmers. As you see in my picture, I've got my daughter at the top and my niece and my son, who we were delivering meals that night. So caught a quick picture.
Well, great. So you have a lot of perspective from your farm credit tenure, but also your off-farm tenure. So you have a lot of rich context to bring to that. Before we dive into each of the C's, I'm curious if you could share kind of this high-level elevator pitch of what happens through that underwriting process. And I think a lot of producers are familiar with that conversation they have with the financial officer. But what happens after that paperwork moves to you?
Yeah, you bet. So many of you are used to coming in and giving all of your information to your financial officer. They may ask you for more information as the day goes on. And then that information is shared with me as an underwriter. Now, I work with your financial officer to discern and work through all of that information and your request. So there's a big difference between if you just call in and say, hey, I want a tractor loan for this amount and this many years, and that's the most information you give, versus if you call in and say, hey, I want a tractor loan because I'm going to expand my operation a little bit. I'm going to also be adding some custom work. And so my neighbors have already said that they're going to use me. So I'll be getting this much income in addition that'll help me pay off this tractor loan. So really the information that you give starts off that process. Your financial officer shares it with me as an underwriter. And then I'm going to look at, if you have given a balance sheet and tax returns, I'll start there. But then if you've given additional information and more to your story of, hey, I'm adding some additional income to this, then I can use that information as well to help in making a better decision.
We're going to switch over. We're going to work through the first C, which is character. But Tara's not going to go very far. She's going to add her perspective for each one as we move through. So the first one is character. And one way to kind of summarize what character is answering the question of how reliable are you? And this is kind of a historic look at your past performance. So one of them is probably very familiar, an idea of how we measure character frequently in the financing space is through a credit score, very common in consumer financing. Of course, that credit score, we know all the ways that gets impacted, how much, how frequently you're making your payments, if you make late payments, or how much debt you have relative to the capacity that's possible. So that's one measure of that. It's worth pointing out that a lot of this character question can be subjective, especially if we go back to a time prior to having credit scores, or if maybe you're a new customer, right? There's not a whole lot of history there to go off of. So we might have to be a little bit subjective. A lot of lenders will tell us that, character is a really important one, that if the character issue isn't resolved, then all the other C's might not be relevant. Character is, a really important one, but it's one that you have to kind of build over time, and you have to help tell that story as to why you're a reliable loan. The second piece, or third piece here, is repayment history. So as you work with a lender over time, they're going to start to get more familiar with your character. Are you someone who pays that note or makes that loan payment a few days early, or maybe a few days late? That could be part of this as well. And the final piece that's really important to consider is just kind of what's your appetite, what's your risk profile towards using debt? Are you highly leveraged? Is it common for you to have a lot of leverage in your operation? Or maybe did you work your debt lower over time and then maybe save that up and make big purchases? So this is all part of that story, and this is all that helps summarize what that first C of character is. I'm going to jump back to Tara at this point and ask the first question I have is, we mentioned the credit score already, but how else do you evaluate character?
Yeah, there's lots of different ways. And like you mentioned, credit bureau is easy. It's a number that's out there. If you've been an existing customer, that repayment history, that helps to give us an idea. But then there's also things like, how ready and willing are you to provide information? If your financial officer asks you to provide 3 years of tax returns and you're like, it takes you 2 weeks to gather them up or call your accountant to send them over, are you really interested in moving things along? Or do you say, yeah, no problem. Actually, I'm going to call my accountant right away and get that information right over to you. So, and then also how willing and able you are to just share kind of your thoughts on your operation and maybe some of your hopes and dreams, and really utilize your financial officer as that trusted business partner to help grow your operation. So willingness and readiness to give information can help be a good judge of character there as well.
So we're going to move on to the second C. Brent, I'm going to ask you to set up the capacity.
Yeah, so capacity is really, really important. And capacity of your business is here in this context relates to, what's the business capacity to generate funds and what's its requirement to use funds. So it's kind of like the flow of funds through business. And so you'll want to look at, how much income can this business generate? And more important, and also as importantly, is how is that income used? One of the things that, you hear this saying a lot, all businesses cash flow right up to bankruptcy. One of the points here is, well, not only do we need positive cash flow, but we need to see ultimate profitability. And by that, I mean, are you generating a positive enough cash flow to kind of replace equipment and other things that are getting worn out over time? So we want to look at just kind of the overall cash flow generation of the business, where that business income is going. Another thing that's I think is really important is having good records with respect to the earnings of the business. So do you have good financial records, not just tax returns, but actual financial records that show kind of your income, hopefully with an accrual adjustment at some point, as well as the cash flow? And are those records accurate? Can we count on them? And then we'll want to think about, what are the projections of the business for generating earnings going forward? As you think about making a change in your business, we're going to require credit. What's that credit going to be used for? How is that going to impact the cash flow generation of the business? And another thing we want to consider in all of this is kind of off-farm income. Off-farm income can be sometimes much more stable than farm income. Some regular source of income may not have a lot of calls against it right off the bat. So it's a nice thing to consider when you look at the capacity of an operation to use credit.
And Brent, we did an earlier webinar series here about off-farm income and how the family living expense, and encourage folks to listen to that, because there's kind of this idea of sometimes farm income is needed to meet those household expenses, and sometimes off-farm income can be enough to actually make investments in the operation. So that could be really important consideration. So Tara, the question we have for you on this space is, what specific measures do you consider here for capacity?
Like we mentioned, tax returns, of course, that's a basic, but we all know that we actually use those to manage our taxes. So it might not be a true picture of your operation. That, of course, gives me a ratio I can work with, which is debt coverage ratio. Now, what we like to look at even better than that is if you have a trend of balance sheets. So when you have a trend of at least 3 balance sheets, we can look at your actual earnings from year to year. That can give us a great picture of how much your operation can afford to expand, to cover in payments, and so on. So that balance sheet trend can be really helpful. And what's great about that is if you can gather balance sheets about the same time each year, if you've got a cattle operation, you want to make sure that you're gathering either when all those baby calves are on the ground or consistently when they're not, because otherwise there's a big difference. Other ratios that we can consider, your operating expense ratio. Are you a high cost operator? Are you a low cost operator? Averaging that out over your acres. So depending on the information that you give us and the amount, there's several different ways we can start to look at that capacity measure.
I think that's a really good point that you shared as we've been preparing for this, is that you get excited about the capacity because with good records and good information provided, there's kind of a lot of ways that you can triangulate, or you could approach the problem from different angles to try to get that capacity issue firmed up.
So true. If one doesn't, necessarily tell the story that we're looking for, of might be a little bit short, then we're going to move on to that next one if we have it available and say, what was this one not telling us? So more information, the better.
Great. Shifting gears to the third C, capital, and kind of the highlight summary here is how much equity is in the business, how many funds are there to really be utilized here. And we want to consider kind of a look at the balance sheet. We want to consider what's going to be the impact of this new loan on the balance sheet. How's that going to impact the debt to asset ratio, for example? What are going to be the implications of a down payment? How is that going to impact maybe our working capital position? So it's idea of sort of what's this impact going to be on the operation. It's also important to consider the balance between long-term versus short-term debts and assets. Sometimes we had a webinar about this as well, but sometimes you can get this sort of out of balance. Maybe you have too many short-term, too aggressive a payoff schedule. Maybe you need to term some of that out to make sure that this is in the right balance. And lastly, we're going to talk about this debt to asset ratio, but the debt to asset ratio is a common metric that comes up within this. And this is, of course, a look at of how much of our assets is being covered by debt. And the alternative here is equity. So this kind of debt to equity, debt to asset, there's a few similar metrics here, but this idea of of all the assets we have, how much of those have a callback to the debt side. So I'm going to ask Tara to come back here and ask another question. What other capital measures do you consider in addition to debt to asset?
We like to look at your current ratio, which is a measure of how many of your current assets are available to pay back your current liabilities. So those payments that you have coming due within the next year. Also in consideration of that is working capital then. That's just a different measure of kind of the same thing. And capital is interesting because one operation may have lower working capital, but they might have offsetting items out there that it's okay that they have a lower working capital measure. They may have strong non-farm income that is offsetting some of those yearly expenses that are coming due or yearly payments. Or they may know that they have lower working capital, so they are having a higher level of coverage of crop insurance this year to help mitigate that risk.
As we were preparing for this, you said that this is kind of a hard one for you because of these offsetting factors that you mentioned. I think it's really great because this is really a great example of why the 5 C's are important, because there's going to be weaknesses or strengths in everyone's story. But you look at one of these, okay, what's going on here and what other parts of the story help buttress that or help support that narrative. So I appreciate you mentioning that. Brent, I'm going to kick it back over to you here for number 4.
Thanks, David. So collateral is really important. I just watched the movie Tin Cup the other night, and he's in a situation where he wants to bet a guy that he can hit his 7-iron further than his arch nemesis, and he says, "I'll bet you $1,000 against my car that I can hit it farther than you." Of course, he hits a really good shot, and then his nemesis hits it and bounces it on the road and beats him, and of course drives off with his car. And my son was like, "Well, what? I don't understand." I said, "Well, that was his collateral. He didn't have $1,000 of cash, so he put up his car against that $1,000." And in some ways, this is a similar kind of idea. These are the assets that you provide to the lender to secure that loan, so that if things do end up not going well, it gives the lender a little bit of comfort that there's some assets that they, have a first claim on. So when we take on debt becomes the senior claimant and gets the first call against those assets. Now, all this collateral is not created equally. Some of it is from a lender's standpoint is maybe a little bit more desirable than others, farmland being a very desirable type of collateral because the laws that govern it are very clear. You can't pick up your farm and move it. It's a really good source of collateral. Then we also have equipment. One of the downsides of that is that it does depreciate and can get broken or whatever, and livestock, die or move or whatever. So not all collateral is equal and might want higher percentages of collateral pledged against the loan, depending on the type of collateral. But really, collateral is for that kind of worst case scenario. Nobody wants to get to a situation where that's required to repay a loan. So it's important, but nobody ever wants to get to the point where it's required.
So Tara, we have a unique question here for you. I'm curious, what's the most unusual item that you've had to consider for collateral in your role?
Oh boy, I'd have to say the helicopter. Had my work cut out for me, kind of researching how to secure an item like that, but it's possible. So yeah, pretty unique situation there.
Okay, like that Brent's example about the car, like there's always these things that you have to consider, and helicopter is a very unique asset to have as collateral. So I think that's a very unique perspective, but also kind of reflective of how you work with everyone involved to make sure that this element can be overcome. So that's really great. I want to talk now about the 5th C, conditions. And these are kind of the details, that are important to keep in mind. The first one that we wanted to mention here, kind of from a theoretical perspective, but also can be relevant, is the overall business environment. And so sometimes, when you put together a loan application and maybe your balance sheet and your income and your overall loan request is very similar to maybe the last 3 or 4 years, but the overall business environment could have shifted, and now lenders might be a little more concerned about making loans in this space. Maybe it's an ag loan for an operating line of credit, or maybe it's a farmland loan. So sometimes this background of what's going on can be significant to what lenders are thinking about as they're reviewing those documents. Another part of this conditions situation, and one that we're going to talk with Tara quite a bit about, is conditions can be details that are attached to your loan to help manage that risk, or to help get that loan in a way that the lender feels more confident and comfortable with it. So one of them might be specific terms around the interest rates. Maybe the interest rate is going to be at X% for a few years, and then it could be adjusted down the road. Maybe there are limits on how the uses of the funds. Maybe there's a request for crop insurance or property insurance to put against this collateral, to put against these assets that are in place. Maybe there's an assignment of payment for government payments. And finally, there could be a request to submit quarterly financials. So these are all conditions that, again, details that help that lender get confident with the loan, and then to also help producers, in most cases, better understand their operation, maybe help improve their processes for management, but gets both parties aligned there to get that lined up. So Tara, I'm really interested. We mentioned, we listed several conditions here. Which one is kind of most common in your experience, or what are some ideas that you have to share about that?
Sure. Well, I'm lucky enough, I get to work with a lot of our young and beginning producers. And so with them, crop insurance is a real common one. Most of them have limited, as we talked, limited equity, limited working capital. And so crop insurance is a condition that really helps ensure that their break-evens are covered, so their repayment is good in the future. So that's a way to offset not only our risk as the lender, but also be a good business practice for them and offset their risk in their business. A lot of the conditions that we look at are not only to offset our risk, but like you mentioned, they're just good business practices for the borrower as well. So even if we weren't requiring them, we would probably expect or think that most of them are doing some of these things anyway.
As we begin to wrap this up, we have a poll question for all of you listening and participating today. And we've talked about all the 5 C's, and we're curious to get some feedback from you all. Which of the 5 C's do you want to learn more about? Which of these kind of piqued your curiosity? Is it character? Is it capacity, capital, collateral, or conditions? All right, so Brent, looks like we have capacity is the biggest one here at 33% of participants. Also had several, about a quarter of folks mentioning conditions. But one of the things here that's worth noting is there was someone who voted in all of these, and I think this is a really important recognition. There wasn't a clear winner, right? There wasn't one that was at 80% versus all the other ones. So pretty tight amongst all of those. So one of the things we want to leave you with is an action item or something to challenge you with, is to use this webinar, today's conversation, as a starting point for a follow-up conversation you can have with your financial officer or your trusted financial advisors. Ask your lender for help. Say, hey, I just watched this webinar. I was curious to learn more about this, maybe how it applies to my specific farm. Can you help me with understanding the benchmarks, or how I can get some goals in place to help me make some improvement? So really take this, use this, your answer to that previous question as a way to get you started down this path. As we wrap this up, before we get to the Q&A part of this, we also want to remind you that this is an overall story. These 5 C's are what we've broken this down into individual components. There is an overall story that's at play here. And so a weakness in one of these areas can be offset by explaining your story in another element of this. There are also areas of emphasis can vary over time, can vary over the farm type. And of course, your business goals and plans are important to be considered. And one of the things to really keep in the back of your mind as you're thinking about this is, how do you combine your 5 C's story, kind of this 5 C's framework, with also your long-term business plans? So this could be an important piece, some important linkages there for you to get pulled together.
So first question, how is the spike in land values, $16,000, $24,000, $30,000 per acre on land auctions, affecting debt to asset ratios? And I think that's a really good question. And when you think about it, increase in farmland prices has really increased the asset side of the equation for most farms. Now, that is especially true if we consider our balance sheets on a market value basis. In other words, we value them kind of at current prices. Now, I would caution very strongly against bumping land values up into that range, because I still think, yes, those were real sales, but you have to realize that, let's say, it's different to have 80 or 160 acres selling for $20,000 an acre than to have 2,000 acres sell for that kind of price. And I have yet to see a sale of that magnitude sell at prices like that. So I think, we have to keep in mind that some of those sales are maybe unique circumstances. I also think there's some evidence that that land market is set to at least reach a plateau at some point, especially with higher interest rates. So I caution people. One of the things I tell people to do is try to avoid making big increases on their balance sheets in terms of land values. And if you do, you also have to remember you have to account for the taxes that would have to be paid if those items were to be sold, because there's a tremendous amount of deferred tax liability on balance sheets of most farm operations. So I kind of view it as a hit or miss, or a 6 of one, half dozen the other when we get to market value balance sheets. So I try and encourage people, look at one of the most important things you can calculate is what we call earned net worth. And that is the amount of net worth that has been created through earnings, as opposed to appreciation in assets like farmland or off-farm investments. So on my own balance sheet, I will calculate all that stuff, and I put a thing in there so I can calculate, well, how much of that increase came from valuation changes versus earnings. And I think that really can help you make better decisions than just marking up that balance sheet from year to year. Just be careful with those kind of values. Another question that has come in, and this probably Tara's for you, how do you work with young and beginning farmers who don't have as much in terms of capital and collateral at this point?
Yeah, that's a great question. And I'm happy to be specializing in this right now, so I'm glad you asked the question. So there's lots of things that we can do for those young and beginning farmers. We recognize that you're not going to have that capital position or the collateral yet, so we look at your plan. Your plan and your projection is a big part of how we can make a decision. So your plan of how you're going to operate, you showing the willingness and being able to capture what expenses you anticipate, and then also what reasonable income you expect from your operation, and being able to provide that information to us, whether it's sitting down by yourself and gathering that information, or sitting with your financial officer and putting it together, or your other team of experts around you to help put that information together. So in addition to that plan and projection, then articulating your story of that overall operation. So, I'm looking to expand my cow herd from, maybe you just have 10 cows right now and you're looking to expand it, to 50. All right, what steps are you going to put in place? What are your expectations for growth? Immediate, slow, over 5 years, 10 years? What are your goals? In addition, what other offsetting things do you have going for you right now? Do you know that you don't have enough, you recognize you don't have enough capital, and your operation may be smaller at this point? So are you working at the local co-op? Do you work for your dad's operation? Do you work for your neighbor's operation? What other income sources are you working towards and using to eventually put into your own operation? So those other income sources. And then that's when we also pivot and look towards other risk mitigating factors. So that's when the crop insurance comes into play. Can you ensure your break evens? Do you know what your break evens are? Are you maybe there's more to your story that you're coming back into an operation, a family operation? Are you working with your dad? Sorry if I'm going so fast, but I love this stuff because there's so much to it. But are you working into a larger operation where you have the benefit of buying seed with your dad or your uncle or your brother, and so you do get some cost benefits there on some of those larger expenses? Are you putting in getting to purchase chemicals and fertilizer with part of a larger operation? So understanding and letting your financial officer know those things is key to letting us better help you along the way.
Yeah, and I think, Tara, those are all really good points. And one of the things I think newer farmers need to think about is what can they do a little bit differently, maybe than someone who's more established and has more of that capital and all of those kinds of things. So, are there other, maybe service businesses or things they can do to generate income from, what's between their ears, or even labor that can generate some income to make them an attractive credit risk, and maybe allow them to work into a situation where they have more capital and collateral.
Yeah, that's a great point. Like if you are working into like purchasing a sprayer, what are your hopes and dreams with that? Can you go and secure some acres to run that sprayer over? And then you're having someone else help pay for that sprayer as you grow your own operation, but then you get the use of it on your own acres. So that's a great point.
I have another question here. It says, essentially, why does cash rent look differently than a land loan? I could own one farm and rent one. They both cost me the same amount, and one I have it, and then wouldn't have it the next year if I couldn't pay the rent. The other, I could always sell the farm. Why are those different? And I think there's a few things I want to address in that question to start with. One, I don't think there are many situations where, when you look at what the principal and interest payment would be on that farm, it's usually greater than the rent. So in most cases, your P&I is going to be more than a rent. So it's not quite a one-to-one situation. And I think part of the reason it's looked at differently is there's a lot more risk with, extending a whole bunch of credit to buy the entire farm than there is with, say, one with a rent situation. So in other words, yeah, you can sell the farm, but there's also the risk that that farm price could go down as well. And we've been in an environment for the last 20 years where farmland prices have generally just gone up, and that is not always the case. And I think, if we look at some data, we can see that that's not always the case. They don't go down, consistently, regularly, all the time. But when they do, it's because things are really bad, and that creates quite a bit of risk. And so the principal that you've lent on those is substantial. So you're talking about different amounts as well as different risks, and that's why I think they're viewed a little differently. And maybe, Terry, you might want to add something, but I think that's how I would kind of address that. Just different situations. Another question about navigating young people in the beginning farming and ranching. I think we kind of hit a lot of that already, but want to at least acknowledge another question about that. Again, I think things you can do to generate income outside maybe even the traditional way of just farming is going to make you attractive, and you can work into that. And I think that's one of the best ways to do it.
I would like to point out that in Farm Credit Services of America, we do have actual special programs dedicated to those young and beginning producers. So I just encourage you, with questions on these, honestly, call your lender up. like I said, I specifically specialize in young, beginning, and small producers and underwriting. So I am seeing those and building some consistency around how we look at those. So with those resources, just reach out because every situation is different. Not everybody has the non-farm income coming into a young operation, but they may have a dad who is supportive. So there's definitely ways that we can help through that. With our Young and Beginning program, we have special education on learning more about balance sheets and your cash flow and working up a projection. It's great opportunity for those young producers. So definitely, I can't answer all the questions here because everyone's situation is so different, but we have great resources for those young producers coming out. Utilize us for that information.
So another question about when you're looking at rents, you're more attractive to have just a straight cash rent or some kind of a profit share, maybe even a share rent. How are those viewed? And I think it depends on the terms of all of those. And I think my response would be that any kind of rent agreement can be structured in a way that's beneficial, equally beneficial to both parties. It's just important to make sure you work through that and understand, especially when you get into adjustable leases, how those rents could adjust or might adjust, and what the risks are and rewards are for both parties. So I do think it's important to understand how those work. For instance, I'll just give an example. Let's say you base your adjustable cash lease on commodity price of a crop. Well, that's one thing that can influence the revenue of that farm. But if you don't have an adjustment in there for what the yield was on that crop, you could find yourself in a situation where you have really lousy yields, prices are up, you have to pay a lot more rent. Where if it was a revenue-based adjustment, you might not have to. So it just, I think it's just important that both parties really understand those terms, and it's important to work together to make sure that the agreement is beneficial for both parties.
If you're curious, we're going to provide a link there in the follow-up materials, but Brent and I at AEI, our team has put together a podcast season called Nothing Borrowed, Nothing Gained. So if you're really curious about lending and how lending works, we sort of took a step back and really tried to look at what are the vehicles for how producers get the funds for those ag loans. Where does the money come from? And so we'll provide a link to that. So we'll follow up with that. But if you're curious about this topic, you might enjoy some of the history of how the farm credit system came together, how a local bank works. It's all very unique and it all ties back to financial markets, the bond markets, and eventually the Federal Reserve Bank. So kind of a relevant topic, but also fun history lessons there.
That is a great series. I've been listening to it, and I would say if you're interested in this topic, you'll love that series as well. So we'll include that in our follow-up tomorrow, so you can find that podcast pretty easy. So that'll do it for another episode of Two Economists and a Lender. Thank you to Brent, David, and Tara for leading today's conversation, and for you in the audience, thank you for joining us. We look forward to seeing you online again next month.